I'm Scott Matsushima, Chief Lending Officer at HawaiiUSA Federal Credit Union. Our credit union started 87 years ago as Oahu Educators number 3. So we served all of the educational community that wasn't in the metropolitan Honolulu. We still keep our roots in the educational system. We are very vested in financial literacy and really preparing our kids to take the next step in life when they're ready. Over the years, the credit union has grown to approximately 130,000 members statewide on all major islands and about $2.2 billion in assets. I started my career in wireless. I've been in credit risk for almost 20 years, but wireless credit risk was really kind of interesting. What we were dealing with there was effectively unsecured lending because we were subsidizing phones and then getting repaid for that subsidy over time through the monthly recurring cost. It was basically a microloan, and within that microloan segment, it's unsecured money because we didn't repo phones, right? So I think it was there where we really saw material differentials, and this is 20 years ago, material differentials between the generic scores and custom scores in an unsecured environment. Whenever you had an unsecured product, every player at scale had a custom model, whether or not it was regional or national, or even at a state and local level. You really had to get into the statistics and the modeling in order to have that precision. If you didn't have that precision, your decision-making was clouded. Anytime you introduce a custom model, you're effectively doing it in order to either do the same amount of originations and reduce your risk, or alternatively, keep your risk constant and do more originations. So one of those two things is going to happen, and that's just a dependency on what kind of business you want. In this environment, with the rates going up, the demand for money is still there, but the liquidity and the ability to fund is a struggle for many institutions, and I think we are included in that. So having the ability to pivot, keep our origination levels the same while reducing the risk input, I think is really critical in this type of time. So precision and the predictive ability of the model, I think is really where the value is. Hawaii is unique. We have a relatively captive market, or we have had a relatively captive market where the people of Hawaii really wanted to bank with a local institution. I think at one point there were about 100 credit unions in the state of Hawaii. That number's whittled down to, I believe, 48, and potentially could be whittling down some more as the pressures of the new economic situation are starting to manifest. That said, there is an increasing adoption of technology, an increasing desire for the Amazon effect of knowing what someone wants before they know they want it, or in some regards, speed of fulfillment, where you click a button and it's at your doorstep in 2 days. The penetration of these fintechs into the younger generations, I think, is really going to have an interesting impact on the previously captive Hawaii market. We're going to have to keep pace. We're going to have to change the way we do business in order to actually maintain ourselves and compete with the larger financial services players. You know, AI is a really hot topic. There's multitude of different modeling techniques used in AI, and it's starting to expose people. It's starting to expose businesses and getting them comfortable and familiar with this type of modeling methodology. I think one of the biggest things that I've seen in the last 7 to 10 years is I have friends at the big institutions, at the big card companies that have constantly struggled trying to deploy machine learning techniques into production with the regulators. The fact that Zest really supports the product through model risk management, through governance, through fair lending, testing is really important for credit unions that don't have the scale of an Amex or a Chase or a Capital One that can stand up to a regulator and defend it. I've seen the regulatory atmosphere change over the last 7 years, and the appetite to support machine learning techniques has grown. 7 years ago, there was really no appetite. Everything was constrained. So you could use the techniques, but you had to constrain them to the point where the techniques really weren't providing the value that they could. Everybody reverted to logistic regression. Logistic regression is just what everybody knows and everybody's familiar with. So ML AI is really starting to push the envelope on what people are comfortable viewing, reviewing, and doing. You're always going to see uplift in that over generic models because of the custom nature of the build, right? Again, we're in Hawaii, we're in a captive market that has 1 million to 1.25 million people in population. You know, the United States has roughly 300 million credit files that the generic models are built on, right? How represented is my 1 million in the 300 that's used to train, right? So I think natively you're going to see pickups in absolute terms when you do regional models or when you do custom models to specific populations. Better risk assessments generally are going to lead to the swap sets. So our swaps effectively are, who are we bringing up that wouldn't have qualified for credit before? Are there things that we're able to pick up on and see that a traditional generic model won't? One of the challenges with the operational teams is that it's sometimes counterintuitive. So the statistics of it all are not always in line with what we generally agreed consensus as expert judgment. So when someone was 30 years ago reviewing a credit file and effectively making their own credit score in their head, are all those factors truly drivers? Or are they perceived drivers? An operational thing to overcome was just getting people comfortable to trust the data and trust the model. Because just because you think a bankruptcy on file is an indication that they're going to be bad again, the statistics have to bear out. And the data has to actually tell you that because they had a bankruptcy 5 years ago, they are 10 times more likely to have a default on the forward, which actually isn't the case. So it's really getting the operational folks, the folks that were accustomed to expert judgment, to trust the model, right? And let the model do the work. Improving the predictability in challenging liquidity environments is really number one. I think it's also started to train our staff members of how to use statistics and quantitative-based methods in your decisioning, in your pricing, and in your loss forecasting. Whereas before it wasn't really as front and center, Zest has been a really good facilitator for the staff to actually come up to speed on those topics. Zest has been a really good partner for us. The customer success team, I think, plays a very integral role for credit unions. I came from private banks, commercial banks, and I'm used to having statisticians and data people on staff. In the credit union world, that's not always the case. So I think a lot of the value of the Zest partnership is being able to ask the questions that a statistician or a data scientist would be able to answer for you on staff at a commercial bank, and having Zest support us with those metrics. So not having the need to go out and hire a statistician actually having the support model already in place with Zest is a really, really important thing. Previously, when we implemented Zest, we were pricing based on the leading generic score. But intuitively, why are you using one model to predict your risk and make your approvals, and another model that you're not using to predict your risk to do your pricing? So I think from an equity and a fairness standpoint, we got more precise on the decisioning and the approvals, but we didn't leverage that precision in pricing, right? So in these swap sets where you're having people that may not have qualified under the generic score or may have qualified for the highest rate under the generic score being pulled up into a better risk tier, they're going to get better pricing tomorrow as we move into using Zest for pricing. So I think that's kind of really the biggest thing on the current front. The secondary is I'm excited for the portfolio management product. It's really going to help us, again, take a lot of pressure off for our staff that's not data scientists and providing management with the insights that we need to take the right actions going forward. It's really giving credit union organizations without the data and data scientists stack the opportunity to manage their books, to get the insights that you would only get with a data scientist. That data is going to help management make the appropriate decisions, and I think it'll inform risk management and forecasting a lot better. Model risk management for machine learning models is evolving, right? As that changes, if credit unions don't start using the new machine learning techniques, if they don't have the model risk management, then they're going to be left in the dust, unfortunately. And I think it's the unfortunate reality of the demise of institutions that you don't want to become the next Blockbuster, and you don't want to be the next Kodak that is stuck in their old traditional ways and thinks that the future isn't going to affect them. ML is here, ML is the future, and ML is here to stay. So how do we leverage that? How do we make sure that we're keeping up with market as opposed to sitting on the sidelines to wait to see what develops? So this is more of a, I think, if you are toward a market leader, fast followers are going to be the stragglers, and then slow followers are going to be the ones that die. Partner wisely. If you don't have statisticians on staff, then you really need to make sure that you're partnering with a company that has very strong model risk management to stand up to regulatory pressure. Because the minute anything goes unexpected or awry, they're going to challenge your model risk management, and they're going to ask you, how do you know that this is effective? And if you can't produce documentation, if you can't produce validations, you're going to be in some trouble. And you're going to have those dreaded three-letter words, the MRA or the DOR, that can quickly become a C&D or can quickly become a material weakness from a financial audit standpoint.